it going, guys? I hope you're all well, and I hope the trading week has been good for you so far. So I wanted to make this short video on why equities are seeing such aggressive rallies with no pullbacks. You know, such aggressive rallies compared to typical equity movements where we usually have orderly price action. And this is all building on ideas I've laid out on my Substack, which is marketmacrohub.com. And I'm kind of just building a picture. I have been building a picture over the last few weeks on why I think positioning is so one-sided. And this answers why are we seeing such a rally in equities with no pullback. So the reason, in my view, why we're seeing such an aggressive rally without a pullback is because positioning was so one-sided. So we had heavy hedging, we had implied vol blowout, we had forward curve repricing, we had growth expectations repricing, inflation expectations repricing. There's even more to it. There was just a bunch of moving parts under the surface. When we actually begun to rally higher on headlines and the sell-off started to unwind, it becomes so aggressive because of short covering, hedges being taken off, and people were forced to be long. Plus, at the lows, puts got real expensive. And a lot of that protection was closed out because of how expensive it becomes to hold puts when there's no aggressive selling. No fund or major player wants to be paying up massive premiums for puts when the market's just stalling and it's not trading lower, even on further escalation headlines, which was actually happening. We were getting reports on, more bombs being dropped on oil infrastructure, and the market was, selling off on the candle and then meme reverting, 30 minutes later. It was a struggle for the market to move lower, and no one wants to be holding expensive puts when that is happening. It's kind of like a reflexive loop, because that shift in implied vol then causes a shift, positioning skew, forward curve repricing. It's just this reflexive loop where one triggers another. And the unwind, it creates constant mechanical buy-in, also creates short covering, delta hedging flows, and like vol compression, which is kind of what I just said with the whole implied vol. When we got to an extreme, you begin to then see this implied vol compression, and they literally, as I said, all reinforce each other. So every small dip just gets absorbed straight away, rather than turning into any proper retracement, let's say. And we see this very much in COVID and last April, where positioning just became so one-sided that it really doesn't take a lot to shift, because there's so much under the surface. In normal markets, let's say in the S&P, which I'll use this visual before we go into the first one. So in normal markets, we don't have this kind of tension under the surface, right? Implied vol, hedges, positioning, rate expectations, sentiment, and the list goes on. So much tension here and here, and pretty much, as I said here, the positioning becomes ultra one-sided. The market is literally not pricing the chance that things could blow over, which they always do. Under here and here, we have a bunch of that extreme pricing. Whereas when you expect to see orderly equity movements with pullbacks, the market's trading more on earnings expectations, growth, inflation policy. We're not seeing this massive flips in hedges, massive flips in implied vol, massive changes in rate expectations. We're just not seeing that when, the equity market has orderly movements. And I wanted to just use this analogy. So, imagine you pulled back a rubber band, right? Let that first pullback be your put volume. So you're pulling back a rubber band, you have your put volume, just a ton of puts being run through the system when the first Iran strike fears actually, came into fruition. And then what you then do is you call your friend over, you say, help me pull this rubber band back further. Your friend, we're going to represent as positioning here. So, CTA's flip net short, and now there's two tensions under the surface. You're both pulling back on this rubber band. Then you call another friend over. This is now our hedges. We're seeing massive hedges. People paying extreme premiums for puts, and just a bunch of volatility running through at the equity market, just a bunch of implied vol in crude, FX, equities, rates, just a ton. You then call another person over, so now you've got 4 people pulling back this rubber band, and this is just sentiment. Momentum. You have a bunch of people running momentum strats, ton of terrible sentiment. Like, I'll get onto this at the end, but it's funny because everyone just positions for an absolute extreme. So, you've now got 4 people pulling back this rubber band, and then you've called another person over, and now there's 5 people pulling back this rubber band, right? And this fifth person is the growth, inflation, and policy repricing, which we see massive changes of. So look at this chart representation. At the extreme, you look at the December 26th contract, we started pricing a 22.5 basis point hike. So this is a massive extreme compared to, when we was down here, we were actually pricing something like between 2 and 3 cuts for the year. So now you've got these tensions, you've got so much tension behind this rubber band. Growth, inflation, and policy repricing, and then, as I just spoke on, you've got that 6th person, which is rate expectations. There's so much tension behind this rubber band. And then what happens when one flips? That could be put vol, so implied vol, positioning, hedges, sentiment, even rate expectation. It's just a reflexive loop, right? And it all starts in rates, FX, and the equity market is always a reflection of, what the rates and FX market are doing. And then what happens? We have one trigger and a massive release, massive release. Short covering, puts closed, sentiment FOMO, growth, inflation, and policy repriced, cuts unpriced, or repriced, I should say, and vol collapses. And look, that is when you get no orderly movement and there's no pullbacks. A massive movement. It just kind of takes me to my favorite quote in markets, right? Which is this. It's from Mark Twain. So, I'm an old man and have known many problems, most of which have never happened. You just look at the equity market itself, and it's funny because as humans, everyone prices for an absolute extreme at these lows. As soon as something hits, we price for an absolute extreme. But, 99%, I would like to say of the time, it just doesn't get realized. So you go back to this quote: I'm an old man and have known many problems, most of which have never happened. So it's just, once again, reiterating the fact that we get these massive extremes in the market, we get massive one-sided positioning, and then that ultimately leads us to this catapult situation where we get no pullback.